All right, so I'm here with Thomas Johnson, financial advisor for Cascade Financial, and we're going to discuss the differences between mortgage insurance and what I call life insurance. He calls it personal insurance. So here we go. Thomas, welcome.
Thank you, Bo.
Okay, so why don't you tell us a little bit about what mortgage insurance is?
Mortgage insurance really is, at its core, it's always a life insurance policy, and then there's usually one extra insurance type that you can add on to it. That be either disability insurance, critical illness, or loss of employment. It's the kind of thing that comes standard when you go into a bank or when you deal with a mortgage broker. It's a requirement. It's something they have to offer it to you as part of the lending deal, just because the federal government realizes the importance of having mortgages insured against death, disability, or illness. So That's what mortgage insurance is in a nutshell.
Okay, so they have to offer it, but the consumer, the homeowner, does not have to buy it.
No, it is 100% elective, and that's a common misconception. A lot of people think they have to take the insurance to get the mortgage, but it is 100% elective, and you still have to apply and qualify.
Okay, so what are some of the advantages of using mortgage insurance?
Really, there's only two that I can think of. The first being is that it's simple and easy to apply for because you're already at a desk, you're already there with your mortgage broker or your banker. The papers are right in front of you, and it doesn't require a separate meeting with somebody like me, so that makes it easy. And then also, it's easier to apply for, and I asterisk that just because they only ask a handful of questions. You might face 3, 4, or 5 questions. Basically, are you a smoker, yes or no, and are you suffering any serious health problems, yes or no? And if you answer no to the second one, then voila, you get a policy in your hands. But the asterisk we'll talk about in a little bit, it doesn't necessarily mean that you are going to be covered.
Right, and actually we'll get right into that right now because that's one of the drawbacks of mortgage insurance as I understand it.
Absolutely. There's a number of drawbacks. The biggest one and the big killer for me is really that you are often not insured or guaranteed to be insured simply because the underwriter doesn't look at it until the time of claim. So the point in time when you were diagnosed with cancer, the point in time when you are hurt and unable to work, the point in time when you're passed away and can no longer defend yourself, that's the point in time that somebody actually looks at your case and decides whether or not you would be covered. So in a nightmare scenario, you've got a widow or a widower who now has to go battle an insurance company over a claim payout for their mortgage insurance after their spouse is long gone because it's now being reviewed at that point in time.
Okay, so just to be clear, because this really blows my mind sometimes. I've heard this before. I actually had a friend who went through this. His mother had mortgage insurance. She was a widow. She passed away. And my friend's family ended up fighting the bank to get the payout. So just because you've dutifully paid into it for years doesn't mean you're going to get the payout when you expect it.
Correct. It is not guaranteed. You are paying the premiums, and the only point in time when you find out whether or not you're actually covered is the time when you need it the most.
Okay, so let's assume that they, for whatever reason, they deny your claim. Do you get all your benefit? Do you get all your payments back?
They're usually obligated to pay back what premiums you paid into it. So that's the minimum amount that you'll get back. For the life insurance side of things, if it's a disability claim and you're denied, it doesn't mean you get your money back.
Okay, so when you're at your worst, when your spouse has passed away, that's when you got to try and figure out whether or not you're going to get the money or not.
Exactly.
Okay, so let's talk then a little bit about the alternative. What other options are there for?
Basically, personal insurance is the alternative. You come in, you see somebody who's a licensed insurance advisor like myself. They walk you through all the options available in the market, and you get to pick and choose the type of plan that works best for you. So if you want life insurance, you take life insurance. If you don't, you don't. If you want disability, you can take it. If you want critical illness, you can take it. Totally up to you on how you customize it. It can be built around your overall financial plan. So if you want more than just enough insurance to pay off your mortgage, if you want enough to cover off your car loan, if you want to pay for your kids' school, if you want to provide for your spouse so they have time to grieve, if you might have estate taxes, you can build a policy or policies that fit that entire goal instead of just being pigeonholed into the mortgage window.
And actually, I just remembered something else too. With mortgage insurance, the first kind, if you pass away, and if they do pay out, who gets that money?
The bank gets the money. The payout is always described as the exact amount to pay off the bank. The money goes straight to the bank, and the mortgage is now free and clear. When it's a personal insurance policy, on the other hand, the money goes to your beneficiary. They can choose to pay off the mortgage or not, and they always get the exact face amount on the policy. So if you've paid off $100,000 on your mortgage balance, you've now created $100,000 more for your estate. Whereas if you've paid off $100,000 and you've got the mortgage insurance, it just means the insurance company's on the hook for less money to the bank.
Right. Okay, and with personal insurance, as you said, you get the money, you decide what to do with it. So if you have no mortgage, or if you have a low interest mortgage, you may decide to keep that and use that money to pay off other higher debts or higher loans.
Exactly. You can invest it, you can pay off loans, it's the beneficiary's money to do what they want with.
Now, having said all that, it sounds like, and I've done enough research on it to know that I believe that personal insurance or life insurance is a better vehicle. It's got to be more expensive than mortgage insurance, doesn't it?
That is the weird thing about it, is personal insurance is one of those rare things where the better product is actually the cheaper product. Case in point, I've got a couple I'm working with right now. He had mortgage insurance to cover just under $400,000 of a mortgage. It was costing them $70 a month just for him. I got them both $500,000 of mortgage on both him and her for the exact same $70 a month. It's a longer term, it's a level payout, it's not decreasing, and it's underwritten up front. So there's no contestability over whether or not somebody's passed away and there's going to be a payout. It is set in stone.
So they're both covered for roughly the same price as one of them under mortgage insurance.
With higher coverage amounts.
With higher coverage amount. Okay. All right. So from what I see, the biggest disadvantage is that people, to get personal insurance, it's an extra step for somebody to go through.
Exactly. They basically have to come to my office. We have a meeting that's usually somewhere between half an hour to an hour. We put in an application. We go through a questionnaire. Because it is personal insurance, in the event that they are applying for a certain dollar amount, or if they have a riskier health history, they may be required to see a nurse. That nurse will take blood, make them pee in a cup, blood pressure, that sort of thing, and those results get sent off to an underwriter, and it can take a couple weeks to get a decision back.
Now, as far as mortgage insurance that comes from the bank, are people able to cancel that after a year?
They can cancel it at any point in time. There's no requirement that you hold on to it for a certain period of time. There's no fee for canceling. Basically, if you cancel within the first 3 months, the person who sold it to you gets charged money for you canceling early, but there's no fee to you as the consumer.
Okay. And if you get personal insurance, if you want to increase it or decrease it at some point down the road?
You can always decrease it, no questions asked. However, if you do want to increase it and get more coverage down the road, you either need to buy a rider up front that allows you to do so, or you have to come back and apply for new insurance.
Okay. And where do people get a hold of you if they want to get
you can find me online at www.cascadefinancialgroup.com. You can call me at 204-837-1960, or you can pop by my office and say hi at 1730 Corridon Avenue.
Well, thank you very much. It's been very enlightening, Tom.
Thanks for having me, Bo.
Take care.